Hey, what's going on, guys? Today we're talking about 5 tips to help you minimize a drawdown in your DeFi portfolio. And the reason why this is super important is because a lot of times, if you lose too much of your money when you're investing into the market, it could take a very long time for you to recover your portfolio, right? And I'll talk a little bit about that in a second here. And in my opinion, one of the major focus as the price trends down is making sure that our portfolio is not going to be trending down further than like what the average market is doing, right? If your assets are trending down more aggressive than what, let's say, Bitcoin or Ethereum is doing, then you could be in a very bad spot because if the market starts to recover, your portfolio might not bounce back as high, right? So we'll go over all of that in this video. And if you're new here, my name is Richard. I'm a yield farmer and a DeFi investor. So let's dive right in here. The first concept that I want to share is that it takes much more gains for you to recover your portfolio if the portfolio drawdown is too aggressive, right? This is the reason why I believe that cross asset diversification is very important and that you need to be able to manage risk and take profits as the market price moves up, right? So let's just say you started with $1,000 here and it could be $1 million or $100 million, right? The math would be the same. If you lose 25% of your portfolio, that's not too bad. You're left with like 750 here. But then what you're going to notice is that you're going to have to make a 33% return to recover your portfolio, right? The reason why is to earn $250 back, you would actually need more return from your smaller capital to be able to actually recover your portfolio. And if we just dive deeper here to 50%, you would then now need 100% of returns to actually bring you back to even break even. And then if you lose 75% of your portfolio, you could be looking at 300%. And then by 90%, you're going to be left with barely any money. And then you're going to make a 900% profit on that $100 to be able to even get back to break even. So this is the reason why like the higher risk portfolio does not necessarily perform well, especially in a weaker market. The reason why is the drawdown could be quite aggressive. And if the drawdown is too aggressive, depending on where you got your entry in at, it could actually be really bad for you. And then you could lose a bunch of money in the process. And then you could take a very long time to recover your portfolio, right? So this is a math that every investor should understand and why it's very important that you protect your capital. And it's also very important that if you can't lose the money that you invest in, you don't put all of that into crypto, right? And even stuff like Bitcoin, you could argue that it is safer than like 90%, 99% of other cryptocurrencies. But at the same time, we never know the future, how Bitcoin would actually outperform or underperform over the next decade or so. So it's always helpful to diversify your holdings, right? So that's the first reason. If you lose too much of your portfolio, it's going to be very difficult to recover. The second reason why you should try to minimize a drawdown of your portfolio is because you could flip long and actually rebuy those other assets when the market kind of bottoms out, right? If your portfolio is dropping less than the wider market, you're going to be able to rebuy a lot of these assets at a greater amount compared to if your portfolio is bleeding faster than the overall market, right? So let's say you bought Bitcoin at 100K, but because you are using some of the strategies that I will be showing you in this video, maybe Bitcoin drops to like 50K, but then your overall investment portfolio is at maybe 60K, right? Instead of the 50K, if you were to just buy and hold one Bitcoin at 100K. So then with that 60K, you could easily swap it back to about 1.2 Bitcoin to be able to actually have a stronger bounce if the Bitcoin bounces higher. So that's why drawdown minimization could be actually really powerful, especially when the market is drawing down. It's very helpful to have less of a drawdown compared to the broader market. And I've talked about it a couple times in the portfolio update videos. Yield farming could be a great way to actually help you with the drawdown minimization, right? So let's dive into the tips and strategies here. And again, none of this is meant to be financial advice. So please do your own research before investing. But the first thing that you guys can do is to add stablecoins to your portfolio. So I show this all the time. This chart is by a famous hedge fund manager called Ray Dalio. He came up with this graphic that basically explains that if you add a lot of assets that are not correlated with each other, you're going to reduce the volatility of your portfolio, right? The standard deviation basically measures the volatility of your portfolio. And as long as these assets generate a good return over time, you will be able to make more money in the market without actually being overexposed to risk. So you can see that the more assets you add and the less correlated you are, the probability of losing money in a given year would actually drop by quite a lot, right? For example, I have a client portfolio that I help manage. They are much more well diversified than like the average crypto investor. And even though our crypto portfolio is still up, our portfolio is performing much better simply because we are well diversified, right? So that's the second tip, is to make sure that you have cross asset diversification, making sure that you're buying different assets like stocks, gold, and maybe some real estate, right? But the first part, having some stable coins would be a great start if you currently don't have any stock holdings or gold holdings, right? Because stablecoins just do not correlate with crypto assets because it's pegged to $1, right? So you could think about that asset as a zero correlation asset. You could add simply like 10, 20% of stablecoins in your portfolio. If the prices trend down, then your portfolio is going to trend down less than people who are fully into crypto. And of course, you could argue that if you hold onto some stablecoins, you would miss the upside volatility, right? So it depends on your own personal market outlook. So if the prices have been quite strong, it does make sense to have some stablecoin allocation. But let's just say we're deep in a bear market, then maybe it doesn't make that much sense to have some stablecoins, right? It could make even more sense to, like, for example, leverage your assets, deposit your Bitcoin and ETH on like different platforms like Aave, and then lend out some stablecoins to actually yield farm with or to loop that asset to accumulate more asset, right? So that is a strategy to capture the upswing. But if you're levered long here and the prices keep dripping down, your portfolio is actually going to draw down than people that has no leverage or have a stablecoin allocation, right? If you're positioned long, a very popular strategy that people like to use is what I just described, right? Lending out crypto, buying out stablecoins, you'll farm with that stablecoin and keep accumulating crypto. But the problem with that strategy is that it typically would make your portfolio draw down harder. And it only pretty much makes sense when the prices are pretty cheap. You start doing that strategy and then you slowly de-risk over time on an uptrend, right? But if the risk of the downtrend is pretty high, you believe that, for example, Bitcoin is breaking like the key support and is losing some key moving averages, maybe we're seeing like a deeper downtrend in the crypto market, then for sure we don't want to be over leveraged. And then we also want to think about having some stablecoin exposure. So that's the first two tips. And again, the reason why cross asset diversification is so powerful is because sometimes crypto would just either move sideways or go down, like what we're seeing this year. But then your stock portfolio would go up, right? So then it kind of balances out the losses that you could incur with the crypto market. Or if your portfolio is pretty much flat, you're not there to like chase the returns of the market simply because you don't have to actually force the return on your investment portfolio, right? Other assets are bringing the return. And sometimes the market could be flat for like a few years or even decades at a time. If you guys just pull up the stock chart or like different assets like gold, sometimes the prices just grind around for like a decade or two. So we got to be patient, think long term, and then get exposure into assets that are likely to outpace inflation and grow in value over time. And the third way to actually lessen the drawdown on your portfolio is to have some crypto to stable pairs. So if you believe that, for example, Bitcoin is going to drop by like 50%, and maybe we're going to bottom out at like around 55K, then you could be taking some of your Bitcoin and then swapping it into stuff like Wrap Bitcoin or Coinbase Bitcoin and depositing it into different pairs like Wrap Bitcoin and USDC on Uniswap to capture that drawdown and also protect the downside of your portfolio, right? in that scenario, you would have much less of a drawdown. But then if the prices do shoot up, you would lose some of your Bitcoin. And then as it gets converted to stablecoins, right? The way concentrated liquidity works is that depending on what range you set, if prices move up, you'll gain more stablecoins. If you are pairing Bitcoin with stablecoins, and if price move down, you would actually gain more Bitcoin in the process, right? But when the prices are very high and then you're happy to take some profits and you've been holding like, let's say 10 Bitcoin for quite a long time, it makes sense to be securing some profits here and then using a portion of your Bitcoin holding to yield farm those like concentrated liquidity pools, right? And again, you guys got to know what you're doing when it comes to concentrate liquidity, but I can run the simulation very quickly for you here. Let's just say you deposit it right now at 90K, right? And let's just say you put in 100K worth of Bitcoin at this current price. So that is about like 1 point something Bitcoin, right? And then we're going to be setting our lower range here. If we expect the market to kind of bottom out at around 50K, we could, for example, set the lower range to be around 40K, and then the upper range could be around like 150K or 175K, right? It depends on the ratio that you want to deposit and the profit that you're actually trying to lock in. So let's just say the lower range, you want to set a $40,000 lower range, and then upper range, you could set like 175K, for example, right? And again, before actually providing liquidity, you want to like try to find the best pools for it, right? But this is just an example. So you can see that if Bitcoin's value dropped by half from 90K, so let's just say we go all the way to 45K, right? And in the previous bear markets, sometimes we have had like a pretty aggressive drawdown of like 70 something percent. So it is possible. Anything is possible in the investment world, right? What you're going to notice is that inside the liquidity pool, you're still left with around 63K, right? So your drawdown is about 37% instead of that 50%. So if we go back to this chart here, it shows you that like a 35 to 40% drawdown, you would only need a 50 to 60% of investment return to recover your investment compared to like a 50% drawdown, right? So it does not actually feel like much, but it is quite a lot when you actually put this into perspective, right? And then if you believe that Bitcoin is cheap enough for you to convert it to all spot Bitcoin, you could choose to exit that position into spot Bitcoin as well, and then potentially even using some leverage strategies on the way up. So that's one of the ways to reduce the drawdown of your portfolio is to use some crypto to stable pair. And then you might be wondering like, okay, isn't your upside capped when it comes to crypto to stable pair? Yes, it is. But that's why we're only using a portion of our portfolio. And then what we also want to realize is that when we are entering with our Bitcoin at, let's say 90K, even if the price move up, you're actually selling your Bitcoin at a price that is better than 90K, right? In the beginning, you're selling pretty much like 50 something percent of your Bitcoin. So let's say you hold like 1 Bitcoin and then you want to put like 0.5 Bitcoin or like 0.2 Bitcoin, then you could actually enter into this position. If you lose all of your Bitcoin, that's not a big deal because you would make some US dollar value in the process, earn some cash flow in the process, and then you still have a bunch of other Bitcoin that you hold on the side, right? So this is a very simple strategy that anybody could implement, and it's actually not very complex, right? You hold on to some of your spot holdings, and then you lock in some profit to kind of minimize the drawdown. And again, because the math of the drawdown, this is very important to actually minimize your drawdown. It's okay, in my opinion, to miss out on some of the upside, but you want to make sure that you don't actually give all of your profits back into the market, right? Simply because, again, if the drawdown is too aggressive, then it would take a lot of investment return for you to actually recover your capital. So that's the third way to yield farm more crypto to stable pair. And you could do that with like altcoins as well, like ETH to USDC or Hyperliquid to USDT. Those two pairs are quite solid and what I look to do all the time with my capital. And then the fourth thing that you guys can do if you are an altcoin investor like I am is to consolidate your positions into ones that have more solid fundamentals, maybe have some catalysts that are coming up that could potentially push the price upward and have a good chance to like sustain a bear market, right? We don't want to hold on too much holdings that we believe that, okay, these assets actually have really weak fundamentals. No one is using the products that these projects are building, right? There's a bunch of like dead chains out there that nobody uses. So we want to think about maybe locking in some losses on holdings that we might not be bullish on anymore, or simply just the thesis was wrong, right? And then maybe pick like 5 to 10 at most different projects that you want to bet on and ones that have a good chance to survive a pretty deep drawdown. So we want to think about like, okay, what if Bitcoin drops by like another 30%, another 50%? Are these projects likely to keep building and survive over time? And if not, then we want to kind of consolidate our holdings a little bit, right? That's what I've been doing over the last few months. I kind of trimmed some of my holdings that are a little bit weak and doesn't really have that strong of the fundamentals into different projects that I believe in, like Hyperliquid or Pendle, that I think is going to be around for at least 6 to 12 months, but ideally, longer in the 2 to 3 years from now, right? And then the fifth way that you could actually hedge the downside and reduce the drawdown of your portfolio is to add a short hedge to your portfolio. So we typically don't want to be short hedging when prices are pretty weak, or you believe that, it could easily double or reverse in price, right? One very simple way is to actually have some stablecoin allocation, and then you could use it to add some shorts on different purse platform like Hyperliquid, right? So let's say you put a short here at like 4K because you believe that maybe that's the price target that Ethereum could possibly break down from. And then you want to think about like, okay, is the price action likely to double from here or not, right? So let's say you were doing your analysis and then prices are trading at 4K. You can add a small short there to reduce the downside of your portfolio. And then if the price keeps moving up, that's not a big deal because you already have long exposure in the market and you could always dollar cost average into your short, right? So let's say you started with 10K, you could use maybe like $2,500 to open a short. And if price goes to 6K, you could add to your position over time, right? Price goes to 8K, price goes to 10K. You have to run the numbers before it actually happens so that it makes logical sense when it comes to actually implementing that short hedge, right? I personally am not short hedging at this point. I expected Ethereum to actually break out. It didn't. So I was still in the phase of like accumulating more stable coins, but now we're seeing like a weaker market. In my opinion, the risk and reward for adding a short right now is not particularly great. So I personally am not adding a short here. I'm just looking to buy more assets if prices keep dipping lower. So if ETH keeps dipping to like, let's say 2K, I want to think about adding some stable coins that I have saved on the side to buy more Ethereum or buy more Bitcoin, right? If the market is particularly weak, that's the best time to buy. And then I could actually slowly dollar cost average into the market with the income that I earn as well. So we want to think about adding a short hedge when the market is stronger. Like let's say you guys are yield farming SOL to USDC and like SOL is just looking really good, but maybe it was trading at like the previous zone of resistance at $250, right? That's the best time to be adding a short hedge, not when it's like near its support zone already. And then you're thinking about adding some short hedge, right? Of course, you could still add some short hedge, but expect the prices to move up. So you don't want to add too much size if you're planning to do a late hedge right now, right? So that's one way to reduce the downside of your portfolio. So instead of a, let's say 50% drawdown, maybe your drawdown is less at like 40 to 30%, right? And again, when you reinvest the profits from the shorts, and then you could also use the capital that is required for the margin for the short to buy these assets, then your portfolio is going to bounce back harder than people that hold the assets up and down, right? And another way to actually hedge the downside of your portfolio is to use a barrel lever strategy. What we're doing is that we're lending out stable coins and then we're borrowing crypto assets like either Solana or Ethereum. Then we're yield farming, let's say ETH to USDC, right? And Let's say you did that when ETH was trading at $4,000. If ETH's price goes down, then you're actually gaining more ETH in the process. That's typically the best time to do it. And in my opinion, again, at this current price point, I don't really like the risk and reward of that strategy. But if the prices are quite strong, that could be a great way to lock in your profit and get some short exposure. So if ETH's price dropped, you could repay the ETH loan that you took out very easily and have some profit left over in the process, right? Let's say you borrowed out 10 ETH, and then because you were yield farming ETH to USDC with a relatively wide range, if price of ETH keeps trending down, you could always withdraw it. And let's just say you gain like 12.5 ETH, right? So 10 ETH becomes 12.5 ETH. You use that 10 ETH to repay the loan, and then you're left with that 2.5 extra ETH that you could do whatever you want with, right? And then you still have that stable coins that is on like different platforms like Aave that you could use to rebuy into the market. So I hope that was helpful, guys. So 5 different strategies. The first one is to make sure that you have some stablecoin allocation. If you believe that the market is going to draw down really hard, you want to have some stablecoin allocation, and you typically don't want to wait for like market weakness for that to happen, right? I've been saying for the last couple of months, it's a great idea to start booking in some profits, to use some of your fees to sell into stablecoins. The reason why is because if we do that when the market is strong, and suddenly there's some weakness, we could always redeploy that stablecoin to gain more upside, right? And then our drawdown would be much less aggressive. And the second is to make sure you have cross asset diversification. We want to make sure we're buying different asset classes to protect our portfolio. The third is to be farming more crypto to stable pairs to reduce the volatility of your portfolio, especially in a strong market, rather than being fully into crypto to crypto pairs, right? Because typically crypto goes up and goes down together, even though like the correlation might not be 1-to-1 for a given asset, right? So we want to make sure that if we want to book in profits, we yield farm with more crypto to stable pairs. And then the fourth is to make sure you're consolidating your weaker positions. So you might want to cut some positions that don't really have a high chance of survival. And then the fifth is to add a short hedge when the market is strong and it makes sense to do so. So that's pretty much it for this video, guys. If you want to learn more about yield farming, feel free to check out the rest of my channel, and I do have a paid course and community as well. If you like the content, chances are you're going to like the community and the course materials as well. Thank you once again for watching. I hope that was helpful. I'll catch you guys on the next one.